afternoon, and a great honor to be on the 10th version of the Delphi Economic Forum. The next session, I think, is a very special one because we usually apply judgment on institutions based on what we know, but it is also very difficult often to apply judgment based on what we do not know. And I think the role of the European Central Bank is one such example, because there is usually a lot of press around the amount of regulation coming out of the European Central Bank, but not enough appreciation of the invaluable role that it plays in financial and monetary stability. Sharon Donnery is part of the European Central Banking System, or what we call the Eurosystem, as a member of the Supervisory Board of the European Central Bank, or else the Single Supervisory Mechanism, or SSM, for the ones close in banking, a position she assumed just in January of 2025. Through this role, Sharon has played a pivotal role previously as the Deputy Governor and Central Bank regulator on financial regulator. She has served as the acting governor of the Central Bank of Ireland in 2019, and she has also led several efforts across European central banks on non-performing loans, but also through the European Banking Authority Consumer Protection Group. Last but not least, she has been a co-chair of the Financial Stability Board Working Group on Open-Ended Funds. It is a great pleasure to introduce Sharon, who will be sharing her thoughts with us today. Sharon, the floor is yours.
Well, thank you very much for the kind words of introduction, and what a pleasure it is to be here with all of you today. As you said, I've just recently moved to the European Central Bank from the Central Bank of Ireland, and this is my first public remarks in my new role, so it's a really special event for me to come and visit you today to talk to you. And of course, as you mentioned, I have a lot of international experience previously, including having very many colleagues at the Bank of Greece, some of whom I know are with you here today, so again, very special for me. So, two timeless pieces of wisdom were inscribed on the ancient walls of Apollo's temple at Delphi. Know yourself, and nothing in excess. Now, these words were meant as philosophical guidance, but I think they evoke what a banking supervisor might advise us all today. Know your risks, and don't engage in excessive risk-taking. But risk-taking is intrinsic to banking. It's what allows capital to be allocated and innovation to flourish. But history has repeatedly shown us the dire consequences of losing sight of those Delphic maxims. Risk is a constant in finance, but the nature of that risk and the task of managing it has grown ever more complex in the 2,500 years since those words were first carved in stone. Technological progress has accelerated not only the pace at which we operate, but also the speed at which risks spread through the financial system. And artificial intelligence has the potential to rapidly and profoundly transform not just finance, but of course the broader economy and society as a whole as well. Cyber risk is now easily a top priority for modern risk managers, and crypto assets, stablecoins, and central bank digital currencies may all transform our payments and banking landscape, reshaping how value is exchanged, how financial services are delivered to us, and even how monetary policy is transmitted. Climate and nature risks are also on the rise, and a declining global commitment to mitigate and adapt to these risks could lead to more physical and transition risks in the future. Globalization, of course, has made the world more interconnected, contributing to our economic prosperity, but it's also made it easier for risks to spread through the system. Because globalization thrives on predictability and trust, it inherently relies on internationally agreed rules to provide stability and fairness and a level playing field. Yet in recent years, rising geopolitical fragmentation has been putting pressure on these very rules and the institutions that uphold them. So in my remarks today, I want to provide an overview of the current risk landscape and then talk a little bit about how we as supervisors are addressing all of these challenges. And I'll argue that a consistent, level playing field in international banking is crucial, not only for financial stability, but also to enable banks to effectively operate and compete across borders. However, this playing field must be more than just level. It must also be fundamentally sound. And as the calls for simpler rules grow louder, I'll argue that the solution is to harmonise rules, not to weaken or reduce them. The complexity of the European regulatory framework is largely driven by national fragmentation, so any meaningful debate on simplification must begin and end with a clear commitment to completing our single market. And rather than lowering regulatory requirements, I think we can reduce complexity by harmonising our European rules. Now, in recent years, the European banking sector has shown remarkable resilience in the face of an uncertain external environment. Supervised banks have maintained strong capital and liquidity positions, even as they were navigating this challenging macro-financial landscape. This resilience really allowed the banks to act as shock absorbers rather than shock propagators when confronted with the significant disruptions that arose during the pandemic, Russia's unjustified war against Ukraine, or the rapid shift in interest rates. But at the same time, I think we should acknowledge that policymakers mitigated some of these shocks effectively. So in response to the sharp decline in economic activity during the pandemic, for example, fiscal measures helped to stabilise the financial position of households and businesses, while monetary policy accommodation protected credit supply, which in turn limited corporate insolvencies and credit losses. Now, let me just give you some quick numbers to illustrate that bank resilience. At the end of last year, the banks under our direct supervision at the ECB reported a common equity tier 1 ratio of 15.8%, compared with 12.7% in the second quarter of 2015. And similarly, liquidity positions have considerably improved, as has the aggregate liquidity coverage ratio. Banks' asset quality remains solid, and the ratio of non-performing loans to total loans outstanding is now just over 2%, well below the levels we observed a decade ago when the ratio was close to 8%. But there is heterogeneity across countries and across sectors. And notably, countries which originally had higher levels of NPLs, such as Greece, have continued to reduce their NPL ratios, while there have been some significant increases in countries with historically better asset quality. So let me just spend a minute on the rebound of the Greek banking sector. I think the turnaround of the Greek banking sector is a success story, thanks to the many actions that were taken here by the Greek government, the institutions, the supervisory authorities, and of course the banks themselves. Many of you will remember that in 2016, the Greek NPL ratio peaked at close to 50%. But since then, legacy loans have been reduced by 90%, or around 97 billion euro. And looking at the banking union more broadly, the outlook for asset quality remains stable overall, but pockets of vulnerability do persist in some sectors. One of our supervisory priorities is to ensure that the banks address deficiencies in their credit risk management frameworks, which will enable them to promptly identify deteriorating asset quality and maintain prudent provisioning levels in the future. Now, while credit risk management remains central to modern supervision, modern risk management demands, I think, a far broader and much more integrated perspective. The global system is becoming more multipolar, with many competing power centres, multidimensional with diverse interconnected risks, and multi-layered in terms of time horizons, requiring simultaneous short, medium and long-term planning. So banks today really need to manage multiple challenges at the same time: short-term volatility, medium-term strategic repositioning, and long-term structural transitions like climate adaptation and digital transformation. And in this context, we now understand that it's important to not only look at specific risk categories, but some of the underlying risk drivers as well. So a brief word on the concept of risk. It's a potential adverse outcome that could harm a bank or the banking system, essentially something that could go wrong, like credit risk, market risk, or liquidity risk. But fundamentally, risks really materialise when there are two distinct factors combined: an external threat, like an economic downturn, climate change, or geopolitical tension, and an internal vulnerability in the bank, like weak governance, inadequate controls, or outsized exposures. These elements can really be seen as risk drivers, explaining why or how things go wrong. So in short, risk describes the what, while the risk drivers, the potential relevant threats and vulnerabilities, really explain the why or the how. So let me say a word or two about geopolitical risk, and then cyber risk and market risk. Now, geopolitical risks, by their very nature, have the potential to disrupt the overall operating environment for banks, and they really have risen in recent years. So at the ECB, we've created a dedicated framework to assess their impact on banks, looking at three main transmission channels: through financial markets, through the real economy, and through the safety and security channel. Of course, we closely monitor euro area financial markets, which remain sensitive to prevailing policy uncertainty, with investors reacting to changes in tariffs, energy prices and geopolitical tensions, which of course we've seen a lot in recent days. On the real economy side, trade tensions might also negatively affect banks' credit exposures to certain countries, to those with additional tariffs, or to certain economic sectors like the automotive sector. And of course, we also carefully monitor banks' exposures in this context. And lastly, geopolitical risks can also challenge banks' operational resilience via the safety and security channel through heightened cyber risk, or in the case of unrest, physical security risks as well. The current environment of heightened geopolitical risk also increases the likelihood of tail events, which are very difficult to predict and quantify. And as geopolitical risks can have bank-specific idiosyncratic effects, it's really important for banks to engage in adequate scenario planning that considers the bank's own business model, its geographical coverage, its sectoral exposures, for example. And it's important to remember that geopolitical tensions are also a key risk driver in the adverse scenario of this year's EBA EU-wide stress test. Now, the nexus between geopolitical risk and cyber risk has also been widely understood. And a recent survey of global bank management shows that banks' chief risk officers see cybersecurity as the single most pressing concern. And 3 out of 4 of them rank cybersecurity as their top risk area for the coming year. Faced with ever more complex cyber threats, which are fueled partly by geopolitical tensions and rapid digitalisation, banks must remain constantly vigilant. And indeed, they reported a higher number of cyber incidents in 2024. And worryingly, we see a significant rise in cyber attacks that target third-party service providers used by the banks. So given their high dependency on third-party providers, I think European banks must be more vigilant, particularly among these rapid geopolitical shifts. Against this background, we continue to look at banks' resilience as part of our ongoing targeted reviews on cyber resilience and outsourcing arrangements. And of course, now we have the Digital Operational Resilience Act, DORA, which came into effect in the EU earlier this year, another significant step, I think, towards enhancing operational resilience. So by enhancing their digital capabilities, banks can improve their competitiveness and ensure their business models remain sustainable in an increasingly digital world. Now, geopolitical events like conflicts, sanctions, or political instability also generate great uncertainty in financial markets, which can lead to increased volatility as investors reassess the potential risks and rewards associated with their investments. Markets, of course, react swiftly to unexpected geopolitical developments, often resulting in sharp price corrections. And I think the developments in the past week have clearly illustrated this. So it's really imperative, I think, that we are vigilant to these risks. And at the ECB, we continue to closely monitor the evolving situation and its impact on the banking sector. As we saw in the past few days, the potential for abrupt asset price corrections remains significant due to geopolitical uncertainty. And high equity market valuations compared with fundamentals, narrowing corporate bond spreads and low risk premiums made financial markets susceptible to policy changes, geopolitical tensions and shifts in growth and inflation expectations. Now, non-banks may be among those who are first to feel this geopolitical stress, and as a result, their interlinkages with banks is a particular concern. The non-bank sector has grown significantly since the global financial crisis, and its share of global financial assets now is around half. Of course, non-banks play a really crucial role in funding the economy, serving as an important complement to traditional bank lending. But increased financial intermediation by non-banks and the accompanying greater reliance on capital markets can often offer significant benefits to our economy as well. And this is really at the heart of the European Commission's Savings and Investment Union proposal, which aims to further diversify the EU financial system and lessen our over-reliance on banks, thereby reducing related risks. But the expansion of the non-bank sector has deepened the interconnection between non-banks and banks, introducing potential risks to financial stability. Banks may have direct exposures to non-banks through their lending and investment activity, or, for instance, during periods of market stress, non-banks may face liquidity constraints leading to asset fire sales that depress market prices and so affect the banks that hold similar assets. The complexity and opacity of some activities of the non-bank sector can further obscure risk concentration, complicating the risk management efforts of banks. So given all of these dynamics, the banks themselves and us as supervisors need to continue to enhance our monitoring and develop robust frameworks to address systemic risks arising from this non-bank-bank nexus. And in this context, we really strongly support the European Commission's consultation on non-banks, in which the Eurosystem has actively participated. And now we encourage the Commission and the EU legislators to seize this pivotal opportunity to reinforce Europe's policy towards non-banks. More concretely, I think Europe should swiftly and fully implement the policy recommendations that were recently issued by the Financial Stability Board. We also need clearer EU governance. Granting greater responsibilities to ESMA, for example, would ensure a cohesive European vision, driving effective coordination and consistency policy standards across non-bank financial markets. Ultimately, reinforcing the policy framework for non-banks from a macroprudential perspective would complement the entire Capital Markets Union agenda. These initiatives would not only bolster the resilience of non-banks, but also safeguard stable funding flows to the real economy and to support growth across Europe. Now, before I conclude, let me share another piece of Greek wisdom. History is philosophy teaching us by examples. So, what's the philosophy that history teaches us? Well, we know that financial regulation tends to move in cycles. Financial crises often follow periods of deregulation or regulatory forbearance, prompting a subsequent tightening of regulatory frameworks. Yet time passes, memories fade, and the push for deregulation resurfaces. But history is very clear on one thing. A regulatory race to the bottom is a race that nobody wins. In 1974, with the collapse of Herstat Bank, which sent shockwaves through international financial markets, the supervisory community responded by creating the Basel Committee, based on the idea that internationally active banks require cooperative supervision and a regulatory level playing field. Since then, the financial system has grown more global, yet that fundamental insight remains unchanged. Resilience demands robust rules. In other words, internationally agreed rules are essential for maintaining stability in an interconnected world. Decades of practical experience and academic research have proven that insufficient regulation and weak supervision can lead to financial crises with enormous costs and devastating social and political consequences. Research shows that a more stable banking sector reduces the negative effect on a banking crisis on GDP growth, providing us with economic resilience during crisis periods. However, these economic and societal costs are just one side of the coin. There is perhaps a less discussed reason for a robust regulation. An uneven playing field does not enhance the competitiveness of international banks. And conversations with bank CEOs clearly reveal that many of them deem faithful implementation of the Basel III reforms to be in their own best interests. So while much is said about the cost of regulation, we must also consider the cost of non-regulation, not only the societal costs associated with financial crisis, but also the compliance costs of navigating different rules across countries where a bank operates. What would be simpler, adhering to one European regulation or 27 national ones? So as I said, rather than lowering regulatory requirements, we can reduce complexity by harmonising European rules. So let me wrap up. While the European banking sector is resilient overall, we must remain vigilant among an uncertain and evolving risk outlook, because complacency invites catastrophe. Geopolitical tensions, cyber threats and market volatility underscore the need for robust foundations. That foundation is our multilateral, rules-based framework, which anchors our resilience and ensures stability. And only by preserving and strengthening this rules-based international order and by harmonising rules where possible can we confidently navigate uncertainty and safeguard the resilience that's essential to our financial system. Thank you again for the invitation and for your attention.